Imagine waking up one morning in the year 2036. Bitcoin is over $1 million per coin. Governments are openly competing for digital reserves. Banks that once mocked crypto now advertise Bitcoin-backed accounts. And millions of people are asking the same terrifying question: how did we not see this coming? Then imagine someone pulls up an old chart from 2026 and realizes something disturbing. Bitcoin had been following the same mathematical path the entire time, through every crash, every panic, every war headline, every Bitcoin is dead moment, almost like the system already knew where it was going. Now here's where the story becomes strange. A physicist, Giovanni Santostasi, studying Bitcoin, claims this isn't random at all. He says Bitcoin behaves less like a stock and more like ancient Rome. Because Rome wasn't powerful simply because of armies or emperors. Rome became unstoppable because it evolved into a living network. A system so large, so decentralized, and so deeply embedded into society that even when rulers collapsed, the network survived. And according to this theory, Bitcoin may be evolving the exact same way right now, not as a company, not as a trend, but as a digital civilization forming in real time. The shocking part? This physicist believes the math points towards something almost impossible to comprehend. $10 million per Bitcoin, not hype, not influencer speculation, an actual long-term mathematical model. At first it sounds insane, but once you see the pattern, you start understanding why some of the smartest money in the world is quietly positioning before everyone else catches on. And by the end of this video, you may realize Bitcoin is no longer fighting to survive. It may already be becoming too big to stop. Quick note before we go deep. Nothing in this video is financial advice. This is education, analysis, and storytelling about ideas that are shaking serious people in finance. Always do your own research. Always consult a professional for your specific situation. Now, let's get into it. In financial markets, most predictions fail. Not occasionally, consistently. Banks miss crashes. Analysts miss recessions. Economists revise their forecasts quarterly and still get it wrong. And Bitcoin has humiliated more predictions than almost any asset in modern history. It was declared dead at $1, dead again at 100, dead at 1,000, dead at 10,000, and again loudly and confidently at 60,000. Every single time, some credible person stood in front of a camera and explained precisely why Bitcoin was finished, and every single time, they were wrong. Now, most people file that away as crypto is just volatile and move on. But a small group of researchers refused to accept that answer. They started asking a different question entirely. What if Bitcoin isn't moving randomly at all? That question eventually led a physicist named Giovanni Santostasi towards something called the power law. Now, before your eyes glaze over at the word law, stay with me. This concept is simpler than it sounds, and it leads somewhere genuinely unsettling. Most companies in history grow exponentially. They explode onto the scene. They dominate. They reach a peak, and then they collapse or become irrelevant. Look at every corporate giant from 50 years ago. Most of them are either gone or shadows of what they were. Exponential growth curves always bend back down eventually. But Santostasi argues Bitcoin doesn't grow that way. He says Bitcoin grows the way cities grow, and cities are a completely different animal. Because unlike companies, unlike empires, unlike most human institutions, cities almost never die. Rome still exists, Athens still exists, Constantinople became Istanbul, but it never stopped being inhabited. London survived the Black Death, the Great Fire, the Blitz, 2 world wars, and multiple financial crises. Why do cities survive when everything around them collapses? Because cities aren't controlled by any one person. They're decentralized networks built from millions of individual participants interacting organically, from the bottom up. No single ruler can kill a city. No single decision destroys it. The network itself has a kind of stubborn distributed life force. And according to Santostasi, Bitcoin may be operating by those exact same rules. Morning, afternoon, or night, where you are right now. Drop it in the comments. And keep watching, because the math we're about to get into is the part that breaks people's brains. Most people still think Bitcoin is just digital money, a faster, borderless version of cash, maybe a hedge against inflation, maybe a speculative bet, but that might actually be the smallest part of what's really happening here. Because if Santostasi's framework is correct, Bitcoin isn't just money, it's a monetary network, a global one, growing in real time, and networks obey strange and powerful laws that most traditional finance education completely ignores. Think about the telephone. When the first telephone was invented, it was worthless. One telephone that connects to nothing is just an expensive piece of metal. 2 telephones, slightly useful. 100, now you have something. 1,000,000, you have infrastructure. 1,000,000,000, you've changed civilization. The value of a network doesn't grow linearly with its participants. It grows much faster. This is the core of something called Metcalfe's Law, the idea that the value of a network scales roughly with the square of its number of users double the users, quadruple the value. The same pattern played out with the internet, with mobile phones, with social media, with every transformational communication network in human history. And according to this theory, Bitcoin is playing by the same rules. As adoption spreads, the network doesn't just get slightly more valuable, it gets dramatically more valuable. Each new wave of participants increases liquidity, increases trust, increases infrastructure, increases the cost of leaving. Think about where Bitcoin actually stands today in 2026. Spot Bitcoin exchange-traded funds are now absorbing billions in institutional capital. Major sovereign wealth funds have disclosed positions. Public companies across multiple continents hold Bitcoin on their balance sheets. Banks that spent years mocking Bitcoin now have dedicated digital asset divisions. Nation-states have gone from banning it to legislating around it. That's not speculation. That's documented reality. And here's what makes this genuinely important. Every single one of those developments was predicted by the Power Law framework before it happened. Not because anyone had inside information, but because network adoption curves have followed similar patterns throughout history. Now here's the part nobody's paying attention to. The current phase of Bitcoin's adoption isn't retail-driven like 2017 or 2021. This time, the slow, enormous capital pools are moving, pension funds, insurance reserves, sovereign endowments. These entities don't make emotional decisions. They make structural ones. And structural decisions take years to fully propagate through the system. Which means, if they're already moving, we may still be very early in seeing their full impact. Comment below. Do you think institutional adoption changes everything, or is it just noise? I want to know what you actually think. Okay, here's where things get genuinely uncomfortable. Because I can tell you Bitcoin is like a network. I can tell you it's resilient. I can tell you adoption is growing. But that's all qualitative. That's narrative. That's story. The reason Santostasi's work hit different is because he went quantitative. He plotted Bitcoin's price against time on what's called a log-log scale. That's a type of chart that turns exponential curves into straight lines, making long-term patterns much easier to see. And what he found was a channel, not a random scatter of data points, a corridor. Bitcoin's price, across 16 years and dozens of catastrophic events, kept returning to the same long-term trajectory on that chart. Specifically, he found that Bitcoin's price scales roughly with time raised to the power of 5.8. That sounds like jargon. But here's what it means in plain language. It means Bitcoin's growth isn't random noise. It means there's an underlying mathematical structure that keeps reasserting itself regardless of what happens in the short term. The 2011 collapse brought Bitcoin down over 90%. Zoom out on the log-log chart. It recovered to the corridor. The Mt. disaster in 2014 wiped out the largest exchange in the world. On the long-term chart, a dip. Then recovery to the corridor, the China mining ban, the COVID crash in March 2020, the FTX collapse in late 2022, which wiped out hundreds of billions in value virtually overnight and sent experienced investors into genuine shock. Every single one of those events in real time looked potentially fatal. The forums were full of obituaries. The headlines screamed collapse. And every single time, Bitcoin climbed back toward the same long-term trend line. Santostasi uses a powerful analogy to explain this. He says, think about climate versus weather. Weather changes every single day. Storms happen. Heat waves happen. Unexpected blizzards happen. You can't predict tomorrow's weather 3 weeks in advance. But climate? Climate moves slowly, deliberately, consistently. You can predict average temperatures across decades with reasonable confidence. In his framework, wars are weather, recessions are weather, regulations are weather, exchange collapses are weather, emotional market panics are weather, but the underlying growth of a global monetary network, that's the climate. And climate doesn't bend to daily chaos. Now here's what makes this particularly compelling in 2026 specifically. According to the Power Law model, we are currently in a zone where Bitcoin's price should be rising toward, or potentially trading within, the upper portion of that long-term corridor. The April 2024 halving, which cut the new Bitcoin supply in half, added a supply-side compression that historically precedes significant price appreciation over the following 12 to 18 months. That cycle is playing out now, and the model is watching. If this framework is starting to make sense. Because what comes next is the part most people miss entirely. Now, I want to be very clear about something. Every Bitcoin cycle feels different from the inside. Every peak feels like this time it's real. Every crash feels like this time it's over. That's just how market psychology works. But there are specific structural changes in this cycle that aren't psychological. They're institutional, legal, infrastructural, and they matter for reasons most retail investors haven't fully processed yet. Let's start with the exchange-traded fund question. Before January 2024, if a pension fund or insurance company wanted Bitcoin exposure, they faced a bureaucratic nightmare. Custody issues. regulatory ambiguity, board-level resistance. Most of them simply didn't bother. The approval of spot Bitcoin exchange-traded funds in the United States changed the plumbing of the entire system. Suddenly, trillions of dollars in traditionally managed capital had a compliant, familiar, regulated vehicle to gain Bitcoin exposure. No wallets, no seed phrases, no crypto exchanges, just a ticker symbol inside the same systems they already use. Within the first year of launch, these funds absorbed tens of billions in inflows. That's new capital entering a fixed supply asset. 21 million coins, no more, ever. That math is not complicated. More demand plus fixed supply equals price pressure. That's not a theory, that's arithmetic. But here's where things start to break down in ways that most mainstream analysis completely misses. The entities now buying Bitcoin aren't just hedge funds chasing momentum. Some of the world's largest and most conservative capital allocators are involved. Sovereign wealth funds from multiple continents have acknowledged positions. Major endowments are running allocation models. Central banks and emerging market economies are treating Bitcoin as a reserve diversification option. These are not fast-moving actors. They don't panic sell. They don't read cryptocurrency Twitter. They operate on investment horizons measured in decades, not months. When capital of that nature begins structurally integrating an asset, the effects don't play out in a single quarter. They compound over years. Think about how gold became a global reserve asset. It didn't happen in a week. It happened gradually, then irrevocably. And here's the comparison that should genuinely make you think. Gold has a market capitalization today, measured in the tens of trillions of dollars. Bitcoin's market capitalization, despite everything it has survived and despite everything it has achieved, remains a fraction of gold's. If Bitcoin captures even a meaningful portion of gold's store of value role, the price implication per coin is staggering. Are you positioned for what's coming, or are you still watching from the sidelines? Seriously. Think about that question, because we're going to come back to it. Let's address the number everyone focuses on, and most people immediately dismiss: $1 million per Bitcoin. The emotional reaction is almost always the same. That's absurd. That's impossible. That's Bitcoin propaganda. And I understand that reaction. I genuinely do, because $1 million per coin sounds like science fiction. But let's have an honest moment with history. In 2011, Bitcoin hit $30. Professional financial commentators called it a bubble. Worthless internet money, they said. In 2017, Bitcoin hit nearly $20,000. Mainstream media declared it the biggest speculative bubble in history. Nobel Prize-winning economists called it a fraud. In late 2020, Bitcoin crossed $20,000 again. This time, institutional players were buying. In 2021, it hit $68,000. In 2024, following the halving and the ETF inflows, it broke $100,000 for the first time. Every single price milestone that now seems obvious was once described as mathematically impossible by credible people with impressive credentials. And every person who dismissed each of those milestones missed life-changing returns. Here's what the Power Law model actually projects. The model doesn't predict specific prices on specific dates. That's important to understand. It predicts a range, a corridor. And within that corridor, it suggests that Bitcoin's fair value keeps climbing dramatically higher as the network matures. Based on the trajectory of the curve, Santostasi's model suggests Bitcoin's floor price, not its peak, but its mathematical floor, should be somewhere in the mid-six-figure range by the late 2020s. And its trajectory toward $1 million falls within the model's upper corridor during the early 2030s. Now here's a layer most people ignore completely. This isn't purely about Bitcoin adoption in isolation. Bitcoin is priced in dollars, and dollars are not neutral. Since the Federal Reserve was established in 1913, the US dollar has lost over 97% of its purchasing power. Since 2020 alone, governments worldwide added debt at a pace that would have been considered catastrophic in any previous era. The global debt to GDP ratio reached levels with no real historical precedent. What that means is that even if Bitcoin's network growth completely flatlined tomorrow, its price in dollar terms would still likely rise over time simply due to currency debasement. You're not just watching Bitcoin go up, you're watching a fixed supply asset be measured against an infinitely inflatable measuring stick. And younger generations? They understand this intuitively in a way that older generations sometimes don't. Millennials and Generation Z have watched housing become unaffordable. Watched their savings accounts pay essentially zero interest. Watched the cost of living outpace wage growth for over 2 decades. They don't trust the system the way their grandparents did, and monetary systems, at their core, run on belief. The moment a generation loses faith in the existing system and starts building belief in an alternative, capital flows can shift in ways that are very difficult to reverse. Share this with someone who needs to understand this before it's too late, because this is the context most crypto conversations never actually reach. But here's what I need to be honest with you about. Because if everything I've described so far sounds purely positive, you haven't been paying attention. There is a deeply unsettling dimension to this theory, and I think it deserves more discussion than it typically gets in the Bitcoin space. If Bitcoin truly follows a network monetization law similar to how cities grow, then the volatility doesn't go away. In fact, in some scenarios, it intensifies. Why? Because monetization events in history are not peaceful. They're disruptive, destabilizing, socially corrosive in the short to medium term. Think about every major technological transition that reshaped the distribution of wealth. The railroad boom of the 1800s created fortunes that made ordinary citizens feel like they were living in a different country than the ultra-rich. Industrialization hollowed out entire craft economies that had existed for generations. The internet created tech billionaires, while simultaneously eliminating millions of middle management jobs that never came back. Every transformation of this magnitude rewrites the rules, and the rules are never rewritten equally. Early adopters accumulate advantages that compound. Institutions gain access first. Insiders understand the game before the public does, and the average person usually arrives somewhere between late and too late. That's not unique to Bitcoin. That's just how paradigm shifts work. But Bitcoin has an additional complication. Its supply is permanently mathematically fixed. 21 million coins. There will never be more. As of today in 2026, over 19 million of those coins have already been mined. Hundreds of thousands are estimated to be permanently lost in wallets with forgotten private keys. Long-term holders are sitting on positions they have no intention of selling. The liquid, tradable supply available to new entrants is actually a tiny fraction of the total. And if global demand keeps accelerating toward that fixed, shrinking supply, the price compression that results could be violent, not in a good way for everyone. If Bitcoin truly becomes a global reserve asset over the next 2 decades, then those who could not afford to accumulate when it was accessible will be effectively locked out of the monetary system it creates. That is a sobering thought, and it's one that supporters of Bitcoin need to sit with honestly rather than brush aside, because the same network dynamics that make Bitcoin exciting for early participants could make it profoundly inequitable for the billions of people who arrive after the monetization is complete. Does that make Bitcoin wrong? I'm not saying that, but it makes the conversation far more complicated than most YouTube videos are willing to admit. And that complexity, that tension, is exactly why this story matters far beyond price predictions. Do you think the system can hold, or is something fundamental already shifting underneath us? Comment below. I genuinely want to hear your perspective. So now we arrive at the question that's been underneath everything in this video. The real question. Not, will Bitcoin hit $1 million? That's actually the smaller question. The bigger question is this. What if Bitcoin's greatest risk isn't collapse? What if the real risk, the one most people are completely unprepared for, is dramatically underestimating what this network eventually becomes? Because history shows us something fascinating about transformational technologies. The people who got hurt the most weren't always the ones who bet wrong. Sometimes the most costly mistake was simply refusing to engage seriously until it was too late. Think about the internet in 1997. Most serious business people looked at it and saw a fad, a toy for academics and teenagers that built their entire existence around it. In those early years, looked ridiculous to mainstream observers. Amazon was selling books on a website. How silly. Then one morning the world woke up and the internet was the infrastructure of everything. And the people who had dismissed it spent years scrambling to catch up. Bitcoin may be entering that exact kind of transition right now. Not overnight, not in a straight line. Network adoption never moves that way. But the structural foundations are being laid. The regulatory frameworks are being written. The institutional allocations are being made. The national strategies are being formulated. And none of that unwinds easily once it's embedded. Now here's the honest framework I want to leave you with. Santostasi's power law model could be wrong. Every model is wrong to some degree. Models are simplifications of a reality that is always more complex than any equation can fully capture. Maybe Bitcoin's growth curve eventually breaks. Maybe a superior technology displaces it. Maybe regulatory coordination across major governments finally suppresses it in ways previous attempts couldn't. All of those scenarios are possible. Possible scenarios should always stay on the table. But here's the single fact that makes dismissing this theory genuinely difficult. For 16 years, through exchange hacks, government bans, regulatory crackdowns, competitor networks, mainstream media obituaries, multiple economic crises, a global pandemic, and the collapse of its own industry insiders, Bitcoin has survived every single time. And every single time it returned to roughly the same long-term trajectory. That's not marketing. That's not ideology. That's 16 years of observable, documented history. And at some point, a pattern that survives everything becomes something different. It stops being a trend and starts being a law. Whether this one is real or not, history will eventually answer. But what history cannot answer for you, is what you decide to do with the information right now. Are you positioned, or are you still watching? Because if this plays out even a fraction of the way this model suggests, the most expensive thing won't be buying Bitcoin. It will be waiting until the story is so obvious that everyone believes it. Subscribe to the Wealth Continuum if you want to stay ahead of the conversations that matter. Not hype, not noise, the actual frameworks that help you think differently. Share this video with one person in your life who's been on the fence about all of this, not to convince them, just to give them the full picture. Because that's what this channel is about, not telling you what to think, but making sure you have what you need to think clearly. The biggest shifts in financial history don't announce themselves. They don't ring a bell at the top. They don't ring a bell at the bottom. They show up quietly in the data, in the infrastructure, in the slow movement of enormous capital, long before the majority realizes what's actually happening. That's what the Wealth Continuum exists to track. Subscribe, stay sharp, stay early. And if Bitcoin's power law eventually proves true, the only question that will matter looking back is this: did you understand what it was before the world caught up? Think about that.